Hello, this is Brian Shannon from AlphaTrends.net. Today is Monday, the 4th of February, 2008, and the market has closed. The S&P 500 lost $1.54 or 1.1%, but you can see here looking at the daily time frame that it really didn't do much damage to the recent emerging trend that we've seen. We did see today very low volume. In fact, the lowest volume it looks like for the year. I don't know what the reason for that would be, or maybe I have bad data here, but very light volume today as the market basically did nothing. Can't really say it did nothing, but on the daily time frame it looks that way. Down 1% obviously is not nothing. If we look at the 10-minute time frame, you can see here that this trend is still intact. The intermediate term trend higher that we've been tracking here for the last week and a half or so. And we've still got that rising 5-day moving average. But the market seems to be tiring in here a little bit. Today it spent most of the day below the average price or below the daily VWAP, which is this dotted line right here, meaning that the average transaction occurred higher than where that market closed, therefore putting most people's new positions for today underwater. Same thing is true for the last 2 days as far as the VWAP goes. So maybe we've got a market that's tiring a little bit in here, and it makes sense that you would expect a little bit more indecision as this market is getting close to some key levels that are there for going to potentially offer resistance. First, we looked at over the weekend this 61.8% retracement of the move from the late December highs to just recently. That comes in at about 141 or so, 140 and a half, 141. We've also got the declining 50-day moving average just overhead. And, of course, we've got this level that had been support in the past, near 141. So a lot of reasons to be very cautious in here right now. The primary trend obviously remains lower. We're getting up to this longer-term level of prior support where you would expect to find resistance, and right now it seems as though it is, but no clear signal yet to get short. So we've got real mixed signals now. I mean, the longer-term trend is still clearly lower. Intermediate-term trend is higher, but the short-term trend over the last 2 days is lower. So when you've got that many mixed messages being sent from the market, it means it's time to go real slow, really be careful about choosing your trades, and don't get too aggressive in either direction. The semiconductor index did give back some of the large gains that it saw Friday. This market was down 8.25 points, or about 2.1%. We saw on Friday that the market made it past that level of resistance we'd been monitoring at 365. That 365 was tested intraday, and then we saw that large rally. So now if this market pulls back, you would expect that hopefully it can find support at that 365 level. Otherwise, I think that we're due for probably a test of the lows. And again, looking at the weekly time frame, the market made it up to this prior level of support near 380, but we were looking also at the potential for a measured move based on this inverted head and shoulders pattern in here up to about 395. So if the market can regain some momentum, and I think for that to occur, you probably need, let's take a look at a 5-minute time frame, for it to get back above 374 and a half, 375. Getting above there, I think that we could see maybe another leg higher that would take some shorts off guard, and then probably that follow-through move would be in jeopardy only if it moved back below 370. So be on the alert for that possibility. And again, the 395 also kind of coincides with this level where we find the declining 50-day moving average, which is now at about 392 or so. So the IWM, Russell 2000, making it close to this prior level of important support near 73, and also the location of the declining 50-day moving average, and also again the location of some potential for Fibonacci based trading resistance near about 74. So 73 to 74 is a key level for this market. We've seen an inside day today. A lot of times an inside day indicate that we're going to see a turn. An inside day again is that today's low was lower than Friday's, was higher than Friday's low rather, and today's high was lower than Friday's high. So basically all of today's trading activity occurred within the prior day's action, so it occurred with it, inside of it, even inside day. We've got the declining 50-day moving average and the declining 200-day moving average, so you got to be very careful in here. Same volume in here, very low on that 10-minute time frame, and now on the 10-minute time frame here, rather, is what I meant. On the daily time frame, we saw a much lighter volume today. Now to look at the 10-minute time frame, you can see we're just below that $73 level, which had been so important on the as far as a catalyst for many people to bail out of these Russell 2000 stocks as it broke down through that support level back in early January. Now we're looking at the 10-minute time frame. It looks like, we've got, maybe you could call this the first lower high. Breaking below today's lows would be a reason to become a lot more defensive, so below about 71.60. We do still see a rising 5-day moving average, but again, we've had a large rally in here, and at least a pullback would not come as a surprise at all. If we take a look again at, since the Federal Reserve cut rates, what I'm doing is drawing the volume-weighted average price since that day right here where they first cut rates on January 22nd. Since then, the average price that this market is traded at was just above $69 a share. So breaking back below that would, in effect, make the Federal Reserve movement ineffective from an equity standpoint for the IWM. And if we were to take a look at the spiders, we could draw that line. You can see right here at about 134 or so. Now, if we look at the Nasdaq 100, that level is much closer as far as the daily VWAP goes. That level is actually down here at about this 44.30 level. And this market, once again, continues to be the laggard. It was down 1.4%. It's been rallying, a third of a percent when the S&P rallies 1%. And now it's down on a percentage basis a little bit more than the S&P 500. And obviously, Google is being a big drag on that. Stock down another $20 today. So, that stock's down about $60 in the last 2 days. And really, it's kind of, again, I'm going to express that I'm kind of amazed that the Qs can hold up as well as it does, in particular when you have Google and you've got Apple that just refuses to bounce in here. Still looking very negative. Just the inability for it to bounce leads me to believe that maybe we've got further downside and more bleeding in Apple. And that's going to, obviously, if we do that, then it'll likely spill over into this NASDAQ where we, the thing that would change my mind about the intermediate term is if it can get back above this 46 level, then I think you're going to see people's confidence maybe become increased as they say, well, the market didn't get hit hard as Apple and Google broke down, so maybe we can buy some of these other stocks and get it pushed up to about this prior level of support from late November at about $49 a share. Also, where we have that declining 50-day moving average. Again, I point out that the 50-day moving average has now crossed below the 200-day moving average. From a short-term trader standpoint, that's really not significant. But if you think about the large institutions that look at the market and move billions of dollars around, that's an important signal for them that the short-term trend, as they view it, the 50-day moving average, has crossed through the long-term trend as they view it, which is the 200-day moving average.